Kate, CAMAC's report on crowdsource equity funding is a very exciting development for early stage ventures and other people looking to raise money using crowdfunding in Australia. The most significant aspect of the report is that it does in fact recommend a tailored regime for equity crowdfunding in Australia, proposing to allow issuers to raise up to $2 million per annum through crowdfunding. Other recommendations include a variety of mechanisms that allow for crowdfunding in a way that isn't currently permitted. So, for example, the creation of a new class of public company, a so-called exempt public company, which will allow for a large number of shareholders, that is the crowd, but without the onerous reporting and disclosure obligations that go with normally being a public company. There's going to be a standardised disclosure template for people seeking to raise money, and they've also proposed a licensing regime for the crowdfunding platforms themselves that deal with matters such as due diligence on the issuers, risk warnings and conflicts of interest.
Daniel, there's certainly some concerns with the crowdfunding, looking particularly at the potential risks to investors. Were there any proposed solutions for this in the report?
Look, this I think was probably the hardest balancing act for CAMAC to deal with. How do you give investors protection without imposing so much regulation that you stifle the speed and efficiency of capital that crowdfunding promises? So for a start, CAMAC proposes that there's a monetary cap on how much investors can invest per investment, and here they've proposed $2,500. And they propose that an individual investor's overall cap for a year on all crowdfunding investments should be $10,000. The idea behind this being that the overall financial risk to an investor using crowdfunding is, in the scheme of things, relatively small. Other investor protections rely on the standardised disclosure arrangements so that there is enough information out there for investors to make a decision without going to the extent of requiring a full-blown prospectus.
Do you see the levels that they've set as the right level, or do you think that they're going to restrict either the capital raising ability or the investment for investors?
I think the levels they've proposed are overall not bad. They are striking a balance between allowing people to participate meaningfully without betting the farm on something that is ultimately likely to be a higher risk venture than other asset classes might be.
And obviously all of this will depend on government support. Do we know when they're likely to respond?
Unfortunately not at this point. There hasn't really been a formal government response to it, and as you say, this isn't going to happen without legislative action, so we're very much hoping that this becomes a focus for the government soon.
Yeah, certainly. Daniel, thanks so much for joining us.
Thanks very much, Kate.